Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Gaming and Leisure Properties Inc. Annual Report. GLPI's primary focus is on acquiring, financing, and owning real estate properties that are then leased to gaming operators. The company utilizes a triple net lease arrangement, which shifts the responsibility of facility maintenance, insurance, taxes, utilities, and other services from GLPI to the tenant. This business model allows GLPI to generate revenue through rental income while minimizing its operational costs. In essence, GLPI's core business involves providing real estate properties to gaming operators under a specific leasing agreement that requires the tenants to cover all expenses related to the property and their operations within it. Unfortunately, I do not have access to the text you provided. However, I can still provide a general essay on what might cause a company's stock price to remain stagnant over a period of time. The stability of a company's stock price is often influenced by various factors that can either positively or negatively impact its value. One possible reason for a lack of significant change in the stock price of Gaming and Leisure Properties, Inc. could be the company's consistent financial performance. If the company has been able to maintain steady revenue growth and profitability over the past year, investors may not see any compelling reasons to buy or sell shares, resulting in minimal fluctuations in the stock price. Another possible explanation is that the company operates within a stable industry with limited competition. This could lead to a lack of significant changes in the stock price, as investors are less likely to be swayed by external factors such as market trends or competitor activity. Additionally, if the company has been able to maintain its market share and continue to generate strong cash flows, this stability may also contribute to the stagnant stock price. Furthermore, regulatory and economic conditions can also impact a company's stock price. If there have been no significant changes in regulations affecting the gaming industry, or if the overall economy has remained stable with minimal inflation or interest rate fluctuations, these factors may not be enough to cause a significant change in the stock price of Gaming and Leisure Properties, Inc. In conclusion, the lack of significant change in the stock price of Gaming and Leisure Properties, Inc. over the past year could be attributed to a combination of factors, including consistent financial performance, stable industry conditions, and regulatory and economic stability. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline in the gaming industry are multifaceted. Lease agreements with major tenants such as Caesars, Bally's, PENN, Boyd, and Cordish play a crucial role in generating rental income. This is further supplemented by interest income on real estate loans and sales of leased properties. Acquisitions and dispositions of assets also contribute significantly to revenue growth. Capital expenditures, including investments in new properties or renovations, can have a positive impact on revenue. However, regional performance varies, with some areas such as Las Vegas experiencing growth, while others like Atlantic City face decline. Historical trends reveal that certain properties have consistently experienced revenue growth or decline over time. For instance, Citigroup and St. Charles have shown steady growth, while Jacoby and Pennsylvania have faced challenges. Understanding these drivers is essential for investors and stakeholders to make informed decisions about the company's financial performance and future prospects. The net income of the company experienced fluctuations between 2024 and 2025. While there were instances where it increased, such as a 5.2% rise to $825.1 million in 2025, other times it decreased, like a 5.3% drop from 2025 to 2024. The profit margins also underwent changes, with an increase of 0.7% from 52.7% in 2024 to 53.4% in 2025. The reasons behind these changes were varied. Timing differences between income receipt and expense payment, as well as the retention of cash for other purposes, contributed to some fluctuations. Higher depreciation expenses, other expenses, net, and a debt extinguishment charge also played a role in altering the net income. Additionally, changes in revenue and operating income affected the calculated profit margins. The company's financial performance was influenced by several factors, leading to both increases and decreases in net income and profit margins. These fluctuations highlight the complexities of financial management and the need for careful consideration of various expenses and revenues. The company's financial performance indicates a significant milestone, the generation of positive operating cash flow. This achievement signifies that the business is capable of producing more cash than it consumes in its day-to-day operations. As confirmed by various pages in the report 58, 62, 64, 69, 73, 74, 90, and 91, this trend suggests a stable financial foundation for the company. The generation of positive operating cash flow is a crucial indicator of a company's ability to sustain its operations and invest in growth initiatives. It implies that the business has sufficient liquidity to meet its short-term obligations and can allocate resources towards strategic investments. This achievement is a testament to the company's effective management and financial discipline, positioning it for long-term success. The company's debt level and interest expenses have undergone significant changes in recent years. On page 52, it is noted that the company issued senior unsecured notes with varying interest rates, terminated forward-starting interest rate swap agreements, and redeemed outstanding senior notes. This resulted in a net increase in debt levels. However, on pages 63 and 64, it is mentioned that interest expenses increased by $7 million, 1.9% increase, due to higher borrowing levels and an increase in cash paid for interest of $27 million in 2025. On page 73, long-term debt decreased from $7,735,877 in 2024 to $7,203,731 in 2025. On pages 85 and 100, it is noted that the company's total long-term debt increased by $1.3 billion due to the issuance of senior unsecured notes. Additionally, on page 102, it is mentioned that the weighted average interest rate under the term loan credit facility increased from unknown to 5.02%, resulting in a significant change in interest expenses. Overall, while there have been fluctuations in debt levels and interest expenses, the company's total long-term debt has increased significantly due to the issuance of senior unsecured notes and higher borrowing levels. The performance of various segments and regions in the given data can be summarized as follows. One segment that stood out for its strong performance was PENN, which accounted for a significant 59.1% of collective income from real estate. This indicates that PENN was a major contributor to overall revenue in this area. Unfortunately, there is no clear information available on regions that performed poorly or well. The report does mention diversification by location across 20 states, suggesting a spread-out approach to business operations. However, without specific data on regional performance, it is difficult to draw any conclusions about areas of strength or weakness. Management is optimistic about the company's outlook, citing no material adverse effects from ongoing litigation. To drive growth, the company plans to continue acquiring gaming facilities through existing or new developments. A key strategy is refinancing debt at attractive terms to secure favorable funding for future business opportunities. The company has also entered into long-term leases, with initial terms ranging from 25 to 30 years, demonstrating a commitment to maintaining a stable revenue stream. Additionally, management believes that non-GAAP financial measures provide a meaningful perspective on the underlying operating performance. Overall, the company's focus is on expanding its portfolio through strategic acquisitions and investments in real estate projects that offer additional revenue streams. The company has made several significant acquisitions in recent years. Notably, the Bally's Chicago Casino Resort was acquired, as well as other strategic assets totaling $3.7 billion since January 1, 2024. Additionally, the company has made acquisitions unrelated to the gaming industry, including real property assets, and is also exploring potential acquisitions that may complement its existing gaming properties. The acquisition of Pinnacle and Tropicana's gaming properties are also mentioned as part of the company's expansion efforts. Furthermore, the company plans to lease out some of its gaming properties and other assets to third parties. While there are no explicit mentions of divestitures, it is noted that the company may be forced to sell or lease certain contaminated properties due to environmental liabilities. The company's financial history reveals a consistent pattern of dividend payments over the years. Specifically, dividends were paid out in various amounts as noted on pages 76, 111, 112, and 125. In addition to paying dividends, the company has also engaged in share buybacks. According to page 125, This was achieved through the issuance of op units to affiliates in multiple transactions. There are growing concerns about the potential for inventory buildup and supply chain disruption. One of the main factors contributing to this issue is the recent changes in trade policy and the imposition of tariffs on imported goods. This shift has created uncertainty and volatility in global supply chains, making it challenging for businesses to predict and manage their inventory levels. The impact of these changes can be seen in various industries, where companies are struggling to adapt to the new trade landscape. As a result, there is a risk of inventory buildup, as manufacturers may overproduce goods in anticipation of tariffs or other disruptions. This not only leads to wasted resources, but also increases the likelihood of supply chain bottlenecks and delays. To mitigate these risks, businesses must be proactive in monitoring market trends, adjusting their production schedules accordingly, and exploring alternative sourcing options. By doing so, they can minimize the impact of trade policy changes on their operations and ensure a smoother flow of goods through the supply chain. That concludes the financial summary for Gaming and Leisure Properties Inc. Feel free to comment below, and I will be happy to answer them when possible.